today's 1 hour we want to spend on trying to understand what SIGP is, which is Faircent Systematic Investment Generation Plan. The presentation would typically be broken up into two parts. The first part, I'm going to quickly talk about what SIGP is, what Faircent is, all of that. And in the later part of the presentation, I'll take you through the performance of SIGP, which a lot of customers have already invested. They would want to kind of hear about that as well. So I'll quickly put out this presentation. And all right, so for everybody's benefit, what Faircent is. Faircent is a marketplace, a two-sided retail marketplace where individual people, people like you and me, come and participate on both sides, right? There are retail people on both sides. On one side, there is lenders. On the other side, there are borrowers. So basically investors and people who need money, right? So this comes from a sharing economy, which is a concept which in the last 5-10 years have boomed in the entire world. So basically, individuals or people are using their assets and making money out of it, right? So or some kind of they have a service or some kind of something that they have, tangible or non-tangible. They're able to kind of make money out of it. So they're putting it out on marketplaces and they're making money out of it, right? For example, if you have a car, you attach yourself with Uber and you can make money out of it. If you have a house which is vacant, you can attach yourself with Airbnb and you can make money out of it. So people are, whole lot of them are doing this. Similarly, if you have money, you can, put this out on a platform and make money out of the money that you have, right? So it's a fastest growing, economy in the internet space. Within the P2P space, I think globally this has grown phenomenally. In fact, there aren't many countries left now where P2P has not entered. So most of the economies you'll see P2P lending, unless the economy is very, very, it's completely solid economy. There, the chances of P2P to get in, for example, Japan, it's very difficult to kind of P2P to survive there because the banks are taking negative returns on the money that you put with them, right? So economies like Japan, it's a problem, but otherwise US, UK, you name a country, it's there. China, Australia, Singapore, all these countries, the P2P has grown phenomenally. Globally, this is growing at a 50 to 80% annualized. It's one of the fastest growing BFSI sectors in the world. In India, this regulation came around in peer-to-peer lending, and most of the countries, regulation is there. In some, the regulations are very tight. It's kind of matured. In some countries, the regulation has just started, like in India. 2-3 years back, they put out a regulation on this industry, and they licensed this to few players to operate. In some countries, the regulation is being contemplated. So there isn't any country where regulation is not in this particular area of business. So RBI regulated this in 2018, and since then we've been peddling this. In fact, we launched a business much before RBI regulated this. It's just that we kind of we're very slow in calibrating our growth in the first few years, and once the regulation came in, we kind of pedaled our way through this particular industry. The platform offers a cheaper source of credit, and that's the reason people come. Individuals are able to kind of get a loan at a cheaper rate from whatever alternative that they have, and also from the investor side, they are able to kind of make more money. So let me give you an example. For example, if you are a bank's customer, you can get a better rate of interest on a peer-to-peer lending platform than a bank. For example, a good HDFC or ICICI bank customer, we're able to offer a 10% rate of interest, right? So it cuts across. So for example, if you're a credit card customer and you've been wanting to consolidate, banks typically don't lend to those customers. In fact, if you roll over the credit, they charge upward of 50%. With GST on inclusive. So a customer like that coming onto our platform could get a loan at 22% and stuff like that. So at every level, we are able to reduce cost, and that's the reason borrowers come onto our platform. Similarly, lenders are able to kind of make more money than otherwise what's, in the bank, lying in the bank unutilized. So that's the reason a lot of people participate in these platforms. Because we are a tech company, we don't have any branches. We, have no big workforce. We are a small company of 100 people sitting out of Gurgaon and, operating across India, 600 locations we, give out loans to. And we use a lot of technology to understand borrowers. Also, the offering is with people, right? So this is just like, an Ola or a Uber or an Amazon app. You get an app, you get a website interface. The control is with people. You can actually um, pick up the borrowers, invest with your own thing. You don't have to kind of rely on anybody else. So it's very fair and transparent, and that's the reason a lot of customers trust the entire the process. Very transparent, and it builds a lot of stickiness because of that. It is a completely tech-based platform, as we're talking about. We run more than 100 APIs to kind of understand borrowers better, and that's the reason it's more analytical. We analyze borrowers historically. Also, we analyze borrowers going forward. Also, we look at borrowers, how their repayment is happening. What are the chances of him to go delay or default. We look at all of that primarily because to understand and make sure that focus is around those customers who will not default your money. So it's completely tech based. We work with a lot of partners to bring in a lot of APIs to validate the borrowers. Apart from that, we have a lot of partnerships. The platform has a lot of partnerships, both on the lending side as well as the borrowing side. I'm going to talk about some of it in my subsequent slides. This works on partnerships because you don't, in internet, they say you don't have to reinvent the wheel. So if there is somebody doing a fantastic job, you just align with them and, forge partnerships so that you're able to kind of bring in those customers, or you're able to kind of, send in some of them to them. So that's the way it works. We are basically a 2,500 crore disbursed, company. We're doing 120 crores a month. We've processed more than 2.5 million borrowers till date. On an average, we do 75,000 borrowers processing a month. We have 2.5 lakh lenders on our platform at any given point in time. For a month, 25,000 lenders participate on our platform. We believe that we have more than 75% of the market share. We were the first one to kind of move in this industry, and also when the regulation came, we were the first one to get the license, and there was a good 5, 6, maybe I think 8 months gap from the time that we got and the next guy got it. So we kind of have we were the first one to start also. So there is a lot of market share we gained in that process. We disbursed close to 2.5. In the last 1 year, we have disbursed close to 2.5 lakh loans. This is in spite of the COVID. On a monthly run rate, we do 25,000 loans a month. That's pretty much 1,000 loans a day is what we process. As I was talking about, we have lending partners as well as the borrowing partners. These partners are large organizations like ICICI Securities, JM Financial, SMC, all these organizations, right from large organizations to small boutique firms, they partner with us and they sell Faircent to their set of customers. Similarly, on the borrowing side, we have organizations bring in their customers to us to get them funded. Okay. So, example, MobiKwik, Myntra, all these companies have large number of customer base. So these captive customers they bring in to kind of fund through our platform. So quickly, one of the things that people have in their mind all the time, on a platform like this, if you're investing, how is it that our money is safe? What is it that the organization doing to ensure that you're mitigating the risk? So quickly, the risk mitigation happens right from the beginning in the borrower's life cycle. When the customer is digitally onboarded, we look at all the demographics, psychographic data of the customer, and basis that we have APIs to validate all this data, whether the information that he is putting in is right or not, right? So at every level, there is a rejection which is going to happen, right? So there are some rejection which happens at the age level, income level, location level, employment status level. There is some rejection which happens. Then it moves to the next level where we do bureau integration. We've done bureau integration through which we're able to sharply segment the customers. So we're able to exclude the bad ones, the ones which have got delayed or defaulted in the past. We look at some vintage also in the bureau. We look at 2 to 3 years of vintage in the bureau for us to kind of move to the next step. We have a lot of other variables on the bureau that we look at before we actually move the case forward. So there are some 20-25 rules through which we figure out whether this customer is the right customer that we should take it forward. So no customer who has defaulted in the past, no customer which is, let's say, new to credit, none of these customers get onto our platform. We kind of stall that at the segmentation level itself. 80-90% of the assessment of the customer, whether we should take the customer forward or not, happens in this segmentation stage itself. From there, it moves to the next step where these customers' data is processed in a rule engine. Rule engine is nothing but 200 variable software which is broken up into further 4 or 5 parameters. And these variables, throughout, score for each and every input or each and every data point that is, put out for this particular borrower. So what this rule engine does is that it kind of tells you how much of money that we can offer to this borrower and at what rate and what is the tenure that we need to fix. So the basis the customer's requirement, basis the customer's profitability, the rule engine matches and accordingly kind of assesses it. So for example, let's say in the previous step, if I'm able to figure out there is a guy who owns a car of 20 lakh rupees, and if he has taken a loan of, let's say, for a car of 20 lakh rupees, and he has a house loan of, let's say, 1 crore rupees, compared to another guy who has taken a bike loan of 50,000 rupees and a credit card of 25,000 rupees. So with that, you can pretty much get to know what kind of profitability matrices that I'm looking at, and what's the kind of offer that I have to give out to these set of customers, right? So it clearly defines who I need to run with faster, who I need to kind of push it out, and ask for more documents, right? So that's what this rule engine does. There are risk analysts or underwriters in the banking terms who also get involved in this step. They kind of call the customer, talk to them sometimes. If the ticket size is big, they have a detailed conversation. All of that happens here in this stage. Okay. Once that happened, moves to the next step, which is the risk mitigants. We basically validate all the documents, all the data, all the this thing given by the customer separately through APIs. So most of these things happen parallelly, but some of them happen post because all these APIs cost money. So once we see that the engine is saying that we can offer him a credit, because a lot of people get dropped at the rule engine level as well, right? Because if it is not matching the score at which it comes through as per our engine or as per our parameter, then the customer gets rejected there also. And then it moves to the risk mitigations. We double check all these data points, employment data, bank statement, all this what the customer is given. We kind of cross validate with the different APIs, the identity, the contactability, the prosperity, where exactly is he living, all of that we get to know through a lot of APIs that we drive here. And after that, once this is through, we move to the last step, which is the verification step, where we do the video verification of the customer through face matching technology. We use his earlier data, which we picked up in the first step. Let's say we would have picked up Aadhaar and it's matched with the selfie and seen what's the match is. So if the match is more than 60%, the customer goes through. If it is more than 90%, the customer, less than 60%, the customer gets rejected, and more than 90%, the customer gets rejected. Because you can't have your Aadhaar picture match up to your selfie, more than 90%. So we all know how Aadhaar picture looks like, right? So that's the last step. And once the verification is complete by the verifier, so the details of all of this is pretty detailed, but I'm just giving you a general sense of how this happens. So verifier actually asks the customers, to go around the house, in his living room, in his bedroom, in his kitchen. Kitchen talks a lot. If it is a loaded kitchen, that means the guy is going to be there for some time. If it is a very light kitchen, chances are that he can, he's just there for a few months or days. So you have to be careful about all these things. So these are all recorded and put into the system. Once the verifier is happy is when the process of disbursement happen. And before we disburse, we do penny drop and figure out the bank account is the same bank account of the customer who started the journey with us, or it's somebody else's. Let's, for example, a woman has started the journey with us. It should not be that the money is going to his husband's account. So we don't allow that. So it's important for us to kind of move the money to the person who started, because it's that person we're evaluating, not somebody else. So the money also has to go to that person's bank account. Okay. In the process, we also pick up some references. It helps us kind of go back to them if the customer is not paying us. So the other way we mitigate the risk is by offering customers products which are very interesting, and also by way of distributing it to a large number of cities, plus fractionalization. There are three things that we do to ensure that it's further mitigated. For example, there are a variety of loans on the platform. Short-term loan, which comes onto the platform. Short-term loans, it can, for a day or for 36 months, it can range like that. There are different kinds of loans starting from 10% to 36%. Also, as I said, we pick up loans from 600 different cities. Now, this is a very important point because a lot of companies focus on one particular city. And we've all seen that in COVID, these organizations are not doing well because, let's say, if they're focused in Mumbai and Pune, a lot of their books would have been, or a lot of their customers would have been in stress right now, not able to pay and all that. So we don't have that kind of an exposure to in a particular city. We are thinly, populated across various cities in this country, right? For example, just for to mention a data point, our largest market is Bangalore, and Bangalore occupies 3% of the entire pie, right? So you can imagine how thinly we are present across the country, and that's by design, right? So we wanted it like that, because if any city goes bad, at least we have only one small portion of the portfolio getting impacted. We also have a very conscious way of picking up, loans from across industries. So this is where the partnerships come into play. So we don't limit ourselves to a particular partner. We have partnerships in consumer loans. We have partnership microfinance. We work with some 4-5 microfinance companies. We have medical loans. We have business loans. We have education, different kinds of loan. That gives a lot of different flavor, and also it cuts out risk to a large extent from different industry segment, right? For example, there were some organizations focused only on travel and restaurants, right? And we all know how travel and restaurant is looking at right now. Yeah? So these are things that we are all taught, but fundamentally what happens when you conduct a business, we all try to take easy way out to kind of build business. So it's easy to scale that way, but it's difficult to build it like this, right? So we've kind of from the very beginning, have taken a very conscious call of, and because our retail public's money was involved, that's the reason we kind of had this kind of an approach. Also, we get captive loans from large organizations, like as I was talking about, MobiKwik, Zest, all these organizations bring in a large number of captive borrowers to us, and we kind of fund them. That again also do not occupy or take more than 5%, at best 7% of my total portfolio. It's just because a large organization like a Flipkart or Amazon is coming, I'll not just build my entire organization on them, right? So it's very important for me, right? The final thing is that from a risk mitigation is fractionalization. This is another important thing. We fractionalize the money of the lenders across borrowers at very small amounts, right? On the retail side, if you're going onto the platform picking up, it's broken up into 1,000, 500, 1,000, 2,000. But if you are participating in the SIGP program, it is fractionalized as small as maybe 50 rupees, 100 rupees, even, I don't know, even 25 rupees. It's so fractionalized. So basically you get to participate with all the, whatever money that you put, you basically are, participating with all the borrowers which are there on that particular program. So that's how the fractionalization works. So with your money, a lakh rupees, you don't give it to a lakh rupees to one guy. It goes across to maybe thousands of them, right? So that's how you mitigate. So all of it is done by technology. It takes care of it, right? Some of this I talked about. We do a lot of curation, as I talked about. Through tech, we are able to kind of knock off 80% of the customer. Data validation happens. We look at a lot of data points for to figure out the ability, stability, and the intention of the customer. We look at social, behavioral, psychometric, mobile, financial, depending upon the partner. Sometimes partner brings in these data. Sometimes, some of the standard, set of data that we look at is credit bureau data, financial data, location data. These are some standard ones. A lot of data we look at before we, make the customer, live on the platform. I talked about the rule engine. We also do e-verification, reference check, physical verification on cases which are a certain amount and above. For example, 2.5 lakh rupees or 5 lakh rupees, depending upon the city that you are in. A physical verification happens. We also do e-mandate, NAC check, depending upon the amount of money that you are borrowing. Once the entire loan on the platform gets funded, there is a loan agreement which gets initiated. So this is an agreement between the lender and the borrower. That's again a legal agreement that we sign online. And after that, the money movement, it happens through an escrow mechanism, which is managed by a trustee. There's another beautiful mitigant which the government has put. So if you technically look at it, we are actually getting money as deposits in our escrow account, right? And from this, account, everybody gets a separate escrow account, and it comes to this particular master escrow account of Faircent, and from there it goes to the borrower's escrow account and kind of gets released to the borrower, right? So if you look at it, it's just like, the way banks, gets deposits, we are getting these deposits. Otherwise, NBFCs are not supposed to collect deposits, right? All the depositing NBFCs have been, RBI has completely stopped that. So RBI said that, if you have to conduct this business, you have to get retail people to kind of to participate. So what I'll do is I'll put a trustee on top of this. So there's not a normal escrow account. This escrow account is, managed by a trustee. So whatever lender is putting the money, right? I take this, instruction of the lender to the trustee. Trustee is the one which instructs the bank, and only then the money moves. So I cannot have any. I don't have any right to this particular account other than viewing rights. I can just view this particular account. Apart from that, I don't have any withdrawal rights. I don't have any, I don't have a checkbook, nothing. I don't have anything to this particular. Everything is managed and controlled. And trustee has a lot of powers also, right? So they can, shut your business tomorrow. It's like that. So they'll stop disbursing, they'll stop giving instruction to the bank, and the business will, shut. So they have the right to audit. All of that is there. So it's a powerful piece RBI has put here to ensure that public money is kept with is safe. That's it. We also have a separate unit of collection. We are spinning that off as an organization separately. We've tied up with a lot of agencies across the country. We are giving this as a service also, intent to kind of in future to other banks and NBFCs, insurance companies, telecom companies, and all that. So that's some plans that we have. But we are very serious about the collection and all this. And we use a lot of technology, a lot of analytics in collection as well, right? So we use early warnings, we use payment, mechanisms, propensity to pay, how this thing the customer is at this point in time to kind of pay. Whether he's paying other NBFCs and banks, or he's just paying us. If that's the case, he might stop paying us very soon. So stuff like that. So we do a lot of in-depth analysis on the collection to ensure that we're focusing on the right sort of customers to kind of move this. Okay, so when you have to put money on a platform like this, it's important to realize that as you climb the risk, the number of borrowers that you have to pick up has to be geometrically increased. Now, the reason for that is because if you look at the returns, okay, it averages out, it's arithmetically improving, and the risk is also, climbing up geometrically, right? So the way it works is that, at the higher risk, the default is much higher. It's not arithmetically, it's geometrically higher, right? So that is the reason to make 14% at a very high risk, you have to pick up a lakh of borrowers. Now that becomes extremely difficult for retail people to kind of do that, right? So you're better off, picking at low risk, 100 borrowers, between 10 to 12%, you'll make some 10% average return. But if you have to kind of make a little more, then you have to kind of get to kind of picking up a lot of borrowers. Now it's physically, not possible. Also, there is a limit of 50 lakh rupees per borrower. So a particular portfolio, if it has to kind of spread across, it becomes very difficult at 50 lakh rupees to kind of pick up a lakh of borrowers. Okay, and that is the reason we have SIGP. Okay, what this does is that it kind of gives lenders a non-volatile stable return. So a pool is created, and all the money kind of goes to this pool, and this pool is what picks up borrowers. So your pool gets, becomes a part of that big pool, and whatever returns that we get, an average is, given out to the borrower. So it's not that, sorry, to the lender. It's not that one lender is making a lot of money and one lender is making lesser amount of money, or, it's they're suffering losses. So what we've done is that we have completely kind of taken that off, and we are saying is that we'll offer you non-volatile stable returns. So nobody has supernatural profits also, and nobody makes any losses also. But that's the way this program works, right? So the money is put in a pool, and now that pool can go and pick up lakh of borrowers, and can give you a stable 12% return. But that's the model in which this works. Okay, and this is an analytical based program, and leveraged a whole lot of analytics we do to kind of pick up borrowers, understand collection, and thereby reduces a lot of time for lenders to kind of pick up borrowers. Otherwise, lenders have to kind of pick up borrowers each and every. Not that you can't do that now. You can still do it, but if you're coming through this program, you don't have a choice. You have to just give us money, and we'll be the one who will be kind of putting out to the borrowers, right? So also this helps borrowers, TAT. It kind of quickly, the turnaround time for the borrowers drastically reduced because of this. The moment the borrower is live, we can give money. For example, right now we have excess of money because the number of borrowers coming onto the platform kind of dropped in the last 2 months. It's just picking up because of the COVID. The consumption completely dropped. Good borrowers I'm talking about. So there's a lot of money lying, and the movement of the money can quickly happen to the borrower who comes online, right? So it's like that. It's super fast. So if the borrower is getting assessed and kind of gets live today, he can get funded within seconds. That's the way it happens right now. And all of this, we are, what you're saying is that we'll, provide and present, in a full transparency, like the way we are doing it, today. And what is it the lender can expect is the 12% return. There are two options: 6 months and 12 months. You basically park your money for 6 months or 12 months. For 6 months, you'll get 11%, and for 12 months, you'll get 12% return. These are flat returns. So basically, you make 12,000 rupees for a lakh of rupees that you park with us, right? So it's lakh and 12,000 at the end of 1 year. Okay, so this is how it's going to look like. So if you're putting 10 lakh rupees, and this is for 6 months, this is 1 year. Annualized, you'll get 11% here, and here 12%. Because this is 6 months, it works out around 7.3. Actually, the return that we are saying that we'll offer lenders at this 6 month product is 5.5 for 6 months. If you're participating in 12 months, you'll get 12%, right? So let's say if I put money to borrowers and I'm able to make 7.3% here and 15.64% here, there will be losses which I'll adjust. There is no fee for the lenders in this program. There will be default. There will be some delays in default because I need to kind of pay out every month to my lenders. So I, reduce that with the gross return and, pay out 5.5 and 12% to my lenders, right? Okay, so how will we ensure the returns? You must be wondering, how is it that you arrived at 12%? Why not 11%? Why not 10%? Why 12%? Now, this is the data that we've seen for the last 8 years, right? And we have seen that we have returned lenders, if at aggregated level, Faircent level, we would have distributed a whole lot of, as I said, 2,500 crores of loans that we've disbursed. And what we have seen is that the lenders are able to make upward of 15% net of all default and everything, right? And that's what we are we have arrived at. if you look at if you look at it from that prism and say that okay, we will offer lender 12% and we'll keep a couple of percentage for ourselves, and that's how this has been structured, and we're using a lot more analytics than what we were doing earlier to get better. And we were not expecting a second wave to hit us so bad because we started after the first wave. We didn't expect the second wave to hit so bad, but still the portfolio is intact. Nothing has happened to the portfolio much. A little bit of some delays are happened, but otherwise there is no problem. But we are here to deliver 12%. Looks like we are here for long, right? Delivering that. Okay, so how we ensure returns in this is that we are initially, building a very conservative portfolio. We are going to have a very conservative portfolio approach. The idea is to kind of not get, not to hurry up. For example, right now I have a lot of money lying. As I said, I'm not kind of trying to kind of get all the borrowers live and quickly fund them, right? So I'm not doing that. So we have a very conservative portfolio build-up approach. I talked about the diversification of across all segments. So even if any segment in future also goes bad, right now we have stalled a lot of segments, which we do that by closely monitoring the data and various sources of borrowers that come to us. Also, the collection strategy, the execution within the collection is also analytically driven, which I talked about. The portfolio calibration that we do, we have done a huge calibration after the COVID. We've seen that certain risk type of customers could kind of damage the portfolio, so we have calibrated that. So 2 years of vintage has gone to 3 years and stuff like that, right? So you have to have at least 3 years of vintage in the bureau only, then you'll get a loan on our platform. So stuff like that we have done. Some of the portfolio companies that they were giving us loans, we have taken that off. They were not doing well, so that's the reason some of them have gone. Some of them, the new ones we are bringing in, which is relevant at this point in time. So that time to time calibration will continue, COVID or no COVID. It's a process that will continue to happen, right? The other philosophy of this team's philosophy is that any money that we make of the high risk borrowers, we will not get greedy and pick up more high risk. We'll kind of try and earnings of that we'll put it in lower risk buckets, right? That you can make sure that income is stable, right? Lastly, it's important for us so when we started this program, we had to create a base of very good borrowers for long-term loans, right? 2-year loans. And that's how it starts. These kind of programs cannot be started with, short-term loans and, slightly risky customers. So it's important to kind of, but the money that I'm picking up is for 6 months and 12 months, but I'm booking loans for, 2 years. So it's important for me to kind of calibrate this as well. As we go along, because start giving returns to the lender, it's important for me to bring in some short-term loans as well. Some loans which are of slightly higher risk, some loans which are shorter in nature, so that the portfolio can be calibrated. It's not that we're going to go a lot of weightage on that. We'll continue to build the long-term loans. Currently, the long-term loans aren't coming because as I said, the consumption has gone down. So I think it'll pick up from next month onwards. So we are able to kind of bring in short-term loans to kind of calibrate this. So there are two levers that we have to calibrate this portfolio. One is the risk and the other is the tenure. And that's how we are able to kind of return lenders the money. So this was for people who had, who are new to SIGP, but this is for, people who have already invested in SIGP. Okay, so if you look at this data, we have got invested 34 crores till now. And we were, when we started, we were looking at 100 crores by the end of the month. I don't know whether it's going to happen or not, but definitely financial year, it will kind of get to that number, 100 crore, right? Now, if you see this, from April onwards, this is kind of started to go down. Okay, this is because of the COVID. And also, this data is, May is not the actual number. This is a 1 week, last week of May is not included in this. But nevertheless, I'm saying this would be around maybe 4.5 crore. So because of COVID, we saw this impact. I think, and also we were not very aggressively asking lenders to kind of bring in money, primarily because the consumption, as I said, the borrowers were not coming the pace at which it should have, right? So that's the reason. So this will pick up this month. We're already seeing a lot of participation. Also, the borrowers have picked up this month, and I think next month onwards we'll be back to what we did in March. In terms of the numbers, I think on the borrowing side, we should be doing more than what we did in March. And from the lending side or from the investment side, I think we should pick up at least 12 to 15 crore. That's the kind of number we should pick up. So that's the kind of demand we supply we're getting from the investors. So this is the channel distribution. If you see, so basically it talks about where am I picking the borrowers from. So we have a lot of pre-approved program where we run a lot of analytics to kind of bring in customers. We have payment wallet companies through which we get customers. We have direct customers coming onto our platform. Again, it goes through some pre-approved program, and also we work with a lot of third-party data. They again have to kind of go through this qualification criteria that we have set before the customer gets onto the platform. So these are typically the mix of channels that we're using. So if you look at every channel, for example, pre-approved, there'll be some 5-6 partners here. Wallet, there will be a couple of partners here. Third-party data, there'll be a lot of partners here. So it kind of have different kinds of sources that we pick up borrowers from. So within that also we have I have not, my dependency is not there, let's say, for only organic or only third party or only in a particular type of this thing. So it's important for me to kind of ensure that I have a different mix of channels as well. Okay, so this is the portfolio mix, the way it is going. If you see, initially when we started, all of it was at a low risk, and I have to return 12%. So I have to kind of get to this level, this level, this level. Okay, this is the maximum level that I will get to, right? So if you see, it is calibrated. It's moving very calibrated way. It is moving towards the side. So if you look at this, a lot of loans we have trying to extend it between 13 to 14% in the month of May, right? Because good loans, the long-term loans are not coming through. So that's the reason a lot of customers of 13 to 14% were kind of put out loans to. So this is something which will keep on changing, right? So this is something that depending upon the type of offering that we have, this will change. For example, let's say if I introduce a 3 months product tomorrow, it'll have a different flavor. This portfolio mix will change a little bit, right? If I introduce a 24-month product or a 36-month product, so this will keep changing, right? Or for example, interest only, okay, or a liquidity within 48 hours, stuff like that. So if I introduce such programs, this portfolio mix also will change. Now, this is what all analytics is all about, right? Because it's important to kind of make sure that we are able to kind of give returns to lenders who are coming and asking for money in 48 hours. Also, lenders coming and asking money for 3 months or 6 months or a year, right? Right now, the offering is only for 6 months and 12 months. We'll, I think soon launch 3 months. I think next quarter or next quarter we should be launching 3 months. We're waiting for 1 year to happen before we launch new product variants on this. Okay, this is the tenure breakup. So I talked about this. Majority of them are sitting long term. If you see this, this is 24 months, 18, 24 months, 40% of the portfolio is around there. So as you go along, you will see that this portion will also now start to grow, right? Because now we've started, giving out loans on this segment. So that's the way this will get built, right? Also, we want to kind of stay away from that 12% mark, slightly away, because we don't want to kind of come down. So because if you are, spreading the money for 2 years, and you're, giving out at whatever, 10, 12, whatever, 13, 14%, for a year, you can't be kind of giving out 12% to the lender. So it's important for me to kind of make sure that I'm putting at short-term loans and kind of balancing that out. This is the bureau score. The average credit score is 693, and the split between salaried and self-employed is, favor towards self-employed close to 63%, 64%. Now, this has happened because of COVID as well, right? And after the first wave, we saw a lot of salaried customer, and the completely different way, the way the salaried customer and the business customer behave, or self-employed behave, right? It is very clear with self-employed, we know that he's in this business, he's going to be there, he's opened a shop again, his revenues have started, his cash flows are looking, strong again. But for salaried, it becomes very difficult to, at this point in time, to judge, right? So you don't know whether this guy is going to be in that job we even don't know whether the company that he's working will be able to survive or not, right? Sometimes. So it's important for us to focus on things which are clearly visible than something which is a little opaque. So that's the reason this focus is kind of shifting towards that side. And there are a lot of micro SMEs in this country. There are 60 million micro SMEs, and they are credit starved. Banks and large NBFCs don't reach out to them. We kind of trying to reach them out to, and they're good businesses, right? So and the average ticket is 1.9 lakhs. So this is the typical demographic. So the age is mostly is around 30 to 40. This is because of the self-employed. This is moved to kind of 30 to 40. Otherwise, we have typically been in the 25 to 35 range, right? So because a mix of salaried and the self-employed. Gender, majority male, 92% of them are male. Qualification, graduate, more than 60% or close to 60% of them graduates. Employment, we talked about 64-36 rate, right? So geographically, again, this borrowers of these programs spread across India. Wherever we have not reached, I think we should reach in a couple of months or maybe in a quarter or so. So idea is to kind of spread across different parts of the country so that we don't have dependency on one particular state or city or whatever. This is how a typical salaried borrower looks like. Okay, this is just for your reference. 31-year-old married, stays in Nagpur, working with other builders since 9 years. So it gives me a data point with respect to stability. He's working as an account and HR manager. He earns 75,000 rupees. He has a monthly balance of, quarterly balance of 15,000 rupees. He has a running home loan of last 4 years, paying 22K regularly. He's borrowed 50 lakh rupees and paid 15 lakh rupees without any delay ever. Have served variety of unsecured loans in the past. So this is how a typical. So we've given him 5.25 lakh rupees and paying on time, right? Similarly, here the employed borrower, we've given him 10 lakh rupees. He's also paying on time. His 30-year-old married graduate runs a wholesale trading business of cattle feed. Now, this is what I'm saying, right? So banks and NBFCs don't reach out to these kind of people, right? Small traders, small businessmen, and especially if they need short-term loans for procuring raw material or procuring some or making some payment, the banks are not interested in lending to these people, right? So we are able to kind of put out money to these kind of people. He has his own residence and business premises. He files his GST. All of this is there. So annual turnover is 7 crores. This is how a typical self-employed borrowers, shades of this, right? So all the money that he has taken, no DPT ever, all of that is written here. So just this for academic purpose, right? So this is how the performance has been. So if you look at this graph, the red line is the return pre-loss, right? So that's a kind of return that we would expect it to make, right? The blue line is the one which I have to return to my lenders, and green line is the one which is post the delays, right, or the loss adjustment. And this is how. So what we call loss as anything which is 90 plus. It's not that the 90 plus not gets collected; it does. It's just that the percentage of people who move to that bucket anyways is very, very small percentage, and also within that percentage of people we are able to pick up money from also kind of goes down, right? So it's that's the reason we call that anything which is beyond. So currently it is 0.36%. And if you see, we have improved a little bit, and that's primarily because of introduction of short-term loans, right? The short-term loans will improve the graph a little bit more as we go along in the next subsequent months. Short-term loans are also people pay out in 6 months or at best 12 months, right? So the idea is to kind of keep away from this line, because the more away we are from this line, more money we make. And if we come to this line, we'll not make any money. So our revenues are dependent on how far we are from this line, right? See, the other important thing to realize is that not that I can stretch this line to whatever that I want. I can't do that, because as I said, if I try to kind of take this line more than, let's say, 14-15%, then the borrower's default also will be geometrically happening. So which will again screw the portfolio. So it's a fine balance in which I have to run this. And that's why I said we use a lot of data analytics to kind of do this. So it's interesting, but keeps us on toes. That's the reason. Okay, so this is what it is. So 96.36 is what has been collected. This is the entire portfolio, right? Since the very beginning. This is the count in 30 to 60. There is, from a count point of view, the 2.57, and we have a margin of, in this entire portfolio as it grows, we have a margin of some 2.5%, of losses in this, right? We have kept that, and we have got to one COVID, and this is how it looks like, and it was a nasty one this time. So if you look at 90 plus, from a count, there is only 0.47, and from amount, there's only 0.36. This is as on 24th. This would have, by the end of the month, would have slightly got better because of the collection efforts that we continuously kind of do. Some more payments would have come by the end of the month. So nevertheless, but that's a picture of how the collection is looking in the portfolio. These are some of the recognition. This is for some people who have not known us in the past. So we got a lot of recognition in the past. So we also had one case study going with I'm Bangalore, which is this happened 2-3 years back. This case study I'm Bangalore reported in the Harvard Business Review. So it's a paid case study, still there. In case if you want to buy it, you can buy it off Harvard. So basically, I'm Bangalore guys, the professors and some PhD students had come over to our office. They said that apart from you, nobody is doing at scale a pure play, two-sided marketplace, which is played across, with retail people, individual people in the financial services business, right? You're the first guys, and you kind of scaled it to this level. And there's nobody, in fact. Nobody has 2.5 lakh lenders on one side and 2.5 million borrowers on the other side. Nobody has. So these are some investors and advisors. Mohandas Pai is an advisor. We have a bunch of friends who call themselves angel investors. They've been very instrumental in our journey. And we have some marquee investors, GM and ICICI Bank, and some Japanese investors and all that. So that's kind of. Thank you, everybody. Thanks a lot. Keep safe. Keep yourself safe. Bye.